Good morning, everyone. Thank you for joining me today in what is going to be my budget briefing webinar. Just would like to start by making an apology for the leak of my slides. So some of you would have had the opportunity to see my slides 10 minutes earlier, and I'd like to apologize for anyone who has seen this so they know the content of today's slides. Hopefully you can all hear me, and you'll have the opportunities to ask questions throughout the webinar. There's a Q&A section on the right and the chat facility if you'd like to comment on anything. And I'm going to address any questions towards the end of today's webinar. The webinar is being brought by my company, Fusion Consulting Group, and we are one of the first companies to fully establish a qualified professional services group. We fully believe that entrepreneurs, business owners, and families want and need all their core advisors within the one company, enabling them to achieve optimum efficiencies on any given set of circumstances, saving them time and money. So we've got in-house tax advisors, accountants, wealth planners, lawyers, CFOs, and international tax advisors, with the idea being to form a client's private office. For those who don't know me, my name's Mitch Young. I co-founded the Fusion Consulting Group. I'm a qualified tax advisor, and I am also known on social media, for those who have joined from my social media page, as Mitch the Tax Man. So if you do enjoy my content, please let me know, continue to follow. For those who don't yet follow me on social media, please feel free to follow me at Mitch the Tax Man to enjoy regular news, tax news and updates. Now, of course, today we've got a lot to cover in terms of the budget. So I'll be talking about the key themes that you should be aware of from a taxation point of view. And then also towards the end of the budget, I'll be talking about some of the things you may want to consider prior to the end of the tax year, being April 2026. I also should say that we are offering a free consultation to all attendees. There is a booking link which is attached to the chat functionality. So if you would like to discuss your matters with me in obviously a more private setting, then I'll be happy to speak with you for around half an hour, understand your matters, and then see if you require any taxation advice. You can book directly, so that will go into my colleague's calendar, and then essentially you'll be able to book a convenient time with him in his diary, and then he will arrange the time for me and you to meet. So the link is in the chat functionality, and so feel free to book that in. This webinar is being recorded, so a copy of the recordings will essentially be sent out via email. Okay, so let's dive right into it. So 26 billion of tax rises was the headline of this budget. And it was a budget where she was focusing on increasing welfare and potentially taxing more of the middle earners and the wealthy, with not many incentives for business owners and entrepreneurs in the UK, unfortunately. In terms of tax, if we start with the income taxes, first off, there's going to be a 2% rise of income tax for dividends. So as we can see on screen, what this means is that from 8.75 at the basic rate of dividend is going to 10.75, and then the higher rate to 35.75. There's no additional increase on the additional rate of income tax for dividends. What this will mean in reality, and I'm sure a lot of company directors are looking at this anyway, is that it doesn't make huge amounts of efficiencies whether you're going to be declaring yourself a dividend or paying yourself a salary. Essentially, it will come down to more cash flow modeling, what your company can do, what makes sense for you and your company. Of course, you're going to get the corporation tax deduction of the salary, but you've got national insurance on it. So there really isn't too much in it, and it will be on a case-by-case basis now. But that 2% additional income tax is coming in from April 2026. A 2% increase on income tax of your savings income is coming in from April 2027. And we have this new tax band, if you like, for landlords. So the government continue to hit landlords. And in this instance, when we're talking about landlords, we're talking about individual buy-to-let investors, not company owners that have buy-to-lets. So if you own property as an individual, your rental profits are going to be taxed at a further 2%. So as we can see on screen, the rates are going from the basic rate of 20% to 22%, 40 to 42%, and the additional rate is increasing as well, unlike dividends, from the 45% to 47%. This is coming in from April 2027. It's another blow to landlords, and it's either going to mean, of course, the rents going up, or it's going to mean more landlords looking to exit the market, or it will force landlords to move forward with their plans to either gift properties, put them into trust, or indeed look at incorporation, which I'll come on to in a later slide. One of the biggest headlines from the budget, which I'm sure you've all seen, is the freezing of the tax thresholds for the next 3 years. This is going to drag more people into the realms of tax and drag more people into the higher rate of tax or additional rate of tax, depending on their income growth. One thing that you may not have seen is that, and I'm sure we have a few investors watching today, into EISs and VCTs, which are essentially tax incentive schemes whereby the government wanted to encourage investment into British businesses. And in order to encourage investments, you essentially would get some income tax relief and some additional reliefs on your investment into these companies. So previously, if you were to invest, say, £10,000 into an EIS or a VCT, you would get a £3,000 tax credit relief on your income tax return. Now, from now, really, that is going to be reduced to 20%. So a bit of a change there. We move on to property taxation, and another highlight is this, or low light, is this introduction of the high value council tax surcharge. So as we can see on screen now, this is being introduced from April 2028. So we've got 2.5 years to get our heads around this. But it's quite simple in the sense that there's going to be an annual charge in additional to your council tax, an additional surcharge. You can see the bands illustrated on the screen. So the entry point is properties valued at £2 million. There'd be this annual surcharge of £2,500, increasing all the way to £5 million plus properties, with the maximum surcharge being £7,500. Is this going to be, is this tax or surcharge really going to impact the market at the top level? Is probably not enough in terms of the taxes to put off activity at the top level. And equally, the tax being relatively low on those, you have to ask the question, what would be the point if it's only going to bring in, I think it was 400 million over the course of the government. We've already mentioned the new tax rates for landlords, individually owned properties. And also the point here is that, as I'm sure we all know, and certainly those who own property in their own name, the ability to deduct the mortgage interest is still removed. And instead of that tax relief amount being 20% of the value of the mortgage interest, what you're allowed to essentially reduce your tax on your property, that is now, of course, increased to the 22% at that level. This makes, of course, owning individual property in your own name, particularly if you're a high rate taxpayer, tremendously inefficient. So what we're certainly expecting to see, and moving forward, if you are purchasing real estate in the UK, it almost certainly will make sense to look at sort of a corporate ownership position on that ownership. Another key highlight from the budget has been the removal of the national insurance exemption from a salary sacrifice scheme. So previously what was happening is that employers would essentially reduce their gross salary to put that into a pension, and you would get essentially a national insurance saving because it would come off the gross. That benefit, if you like, or relief is being removed. It's being removed from April 2029. So again, interesting timing of that. Because actually, probably what may happen is that 2029 is an election year, and that could be something they play around with. But anyway, that's what's being proposed from or coming in from April 2029. If it does come in April 2029, it will obviously mean a lot of people not going through that way of contributing to a pension. Just to remind everyone that if you do want to book in a meeting with me, there is a booking link in the chat function, so you can book that in directly into my colleague's calendar. Then he'll call you and arrange the convenient time, and we will be hosting a Q&A section towards the end of today's webinar. Okay, inheritance tax. This is an important subject, something that I've been helping a lot of clients with over the past few years. So the nil rate band is going to be frozen for the next 3 years, in line with the other allowances. Again, this will mean, because assets will increase, particularly properties, it's likely to bring more people, more estates into the realm of inheritance tax. Well, let's remind ourselves on the big announcement from the last budget, the major change to inheritance tax coming in April 2026. And this was the reduction of the agricultural property relief and business property relief. So just to remind ourselves, previously, if you had a business asset, you could essentially, which was typically shares in your company or your family business, before these rules, you could essentially pass them on to your beneficiaries free of inheritance tax. So if your business was worth 10 million, the 10 million valuation would go into your estate. It would then qualify, if it's a trading business, for 100% business property relief. So essentially, there'd be no inheritance tax on those shares, passing them on to your beneficiaries. From April 2026, that relief is being capped at £1 million per shareholder. Then, above £1 million, so in that example, if you've got a business and your shares are worth 10 million, 1 million would be exempt from inheritance tax, and the remaining 9 million would be subject to inheritance tax at a reduced rate of 20%. So your exposure in that situation would be circa 1.8 million of inheritance tax before you could pass on your shares to your beneficiaries. So that's coming in from April 2026. What was changed in the budget and announced was the ability to transfer that £1 million allowance for business property relief, agricultural property relief, to your spouse on death, like the transferable nil rate band, which you can do 325, 325, 650, or if you qualify for the nil rate band, transfer £1 million. That goes down to the beneficiaries before your estate is subject to inheritance tax. So essentially, to your beneficiaries, if you've got a husband and a wife, the £1 million goes from one to the other, then essentially there would be £2 million of the business property relief before subject to inheritance tax. So that previously wasn't put in last year and is now put in. And in particular for farms up and down the country, that's probably an important part of the small farms planning there. So what that means as well is that we know that's coming in April 2026. We're currently in the tax year we're in, so there still is an opportunity to do planning with the old rules. Some anti-avoidance you need to be aware of, but if you own businesses, companies, farms, then you really need to look at your options now to take advantage of that uncapped amount now and seeing what can be done. Because after April, and then for the period of time in which Labour remain, that is going to be indefinitely capped at that £1 million mark. So it's a really now or never time and opportunity for business owners and families to look at their planning. Also, what was announced and is coming in is that pensions are subject to inheritance tax from April 2027. So previously, pensions, you were able to pass down your pension to your beneficiaries in a tax-free, inheritance tax-free. From April 2027, the value of your pension pot on death will be subject to inheritance tax. Okay, we're going to go on to look at some of the corporate areas. Now, the first couple of points I'm going to talk about employee ownership. And, you know, I think this was her main points about businesses, saying that she's extended the rules and relaxed some of the rules as to giving some of your employees shares within the business, and the qualification on doing so. In particular, the main employee share scheme in the UK is what's called the enterprise management incentive scheme. So they're saying they've reduced some complexities, some of the administration, some of what you need to do in terms of registration for these schemes, and they've extended the size of the companies of what this can qualify. And the idea is that if you've got key management, staff within your company, you want to incentivize them to remain within the company. You can give them shares, register for these schemes, if you like, and they would get slightly favorable tax benefits of doing so. In particular, the share sales or exercise would not necessarily be subject to income tax or national insurance. It's more favorable from the traditional capital gains tax route. So that was announced. The other thing which was announced, which a lot of business owners were looking at previously, was the sale of their business to their employees. So this was being arranged by a trust. So it was called an employee ownership trust, or an EOT. And essentially, the EOT, the rules were it had to be open to all employees, and then the business owner would essentially sell his business, or the vast majority of his business, to the trust, which is owned by the employees. And there'd be considerable tax advantages of doing so. The biggest one was the exemption from capital gains tax if you were to sell your business to this structure. So this is being changed so that the business owner on that sale will only benefit from 50% capital gains tax relief on that transaction. So that's coming in for April 26. And I think what we find is that business owners will look at the alternative routes, and it will only be for really, business owners who really believe in their team and want to leave a legacy to their team, that they may now look at the employee ownership trust route, as it may or may not make sense. So that was quite an interesting change. And she said that there's going to be a lot more anti-avoidance in that area as well. Speaking of anti-avoidance, a lot of structuring around entrepreneurs, businesses, is around the establishment of corporate groups. This is something I help a lot of my clients with, and we work out the commerciality, the viability of whether that's possible and how to do it. The benefit of establishing a corporate group, well, one of the key benefits is that if you built up reserves within your trading business, a lot of the time the directors don't know or don't want to extract those reserves personally to reinvest, because it's going to be subject to a very high amount of income tax via a dividend distribution. If you have a corporate group, what happens is that the holding company acquires the share from the shareholders, so that is now owned by a corporate entity. And then the payment of that dividend, or the distribution of the dividend from the trading company to the holding company, does not result in any tax. And then you could potentially maneuver that dividend. So let's just use £100,000 get paid to the holding company, no tax, and then you can maneuver that £100,000 into a new investment. There's various other benefits of a corporate group as well. But in the budget, it was announced that HMRC are going to put and invest some anti-avoidance money into share reorganizations, because essentially that's the share reorganizations. You're exchanging your shares to a company shares. Now, what that is going to mean is that for every group that gets established, you pretty much will have to form a formal process via statutory clearance, where you write to HMRC, you confirm the commerciality of why you're doing it. It's not just for tax avoidance, Fortunately, as some of my clients on here will know, is that we've been following that process for every single corporate group that we establish anyway. So our clients are ahead of the game on that side of things. But for those who just hear about a corporate group, think it's an easy thing to go and set up, and they go and set up themselves, that will likely not happen in the future. So there's greater scrutiny around cross-border arrangements. HMRC investing millions and millions of pounds in their department. I'll come on to that, particularly around transfer pricing. Transfer pricing is essentially where you may have, your UK business, businesses overseas, and there's no commercial contracts in place. So that will be coming in. It was announced that the penalties for late filing, particularly for corporation tax, are going to double. So whatever they are at the moment, that's going to double. And there'll be new rules around close company distributions received during temporary non-UK residence. So essentially what that means is that if you have a small company, fewer than 5 shareholders, and a UK company, and essentially you leave the UK, become a non-UK resident, and then you want to, say, extract £1 million in a sort of low tax jurisdiction, then of course within that tax year you're not a UK resident, so you wouldn't have to pay tax on that UK distribution. These rules are saying that if you were to essentially come back within that 6-year period, they would look to tax you on that distribution from the UK company. So, just obviously bear that in mind if that's part of your plans, and arrange accordingly. Okay, so another big headline was this introduction of this mileage-based EV electronic vehicle charge, which is being planned from April 2028. And essentially, this is going to be 3p a mile for the mileage that you do in your electric vehicles. So a lot of people have invested into electric vehicles and bought electric vehicles via their companies or as individuals. And what I believe is going to happen is that as part of your annual DVLA form, you'll have to predict the amount of mileage that you're going to do in the forthcoming year, pay that, and then it will get reconciled the year after when you submit, or when you do your MOT, or whatever may be done. Something like that is I think what's going to be coming in. There's an extended first year allowance on capital expenditure. So first year allowance, you'll have an additional sort of 40% figure there to play with if you have got capital expenditures, capital allowances for your businesses. So there was a whole section in the budget notes about HMRC, the government giving HMRC some big funds to improve their compliance in certain areas, particularly the fraud department, and there was a couple of industries in particular that they're going to be targeting. The main one being CIS, Construction Industry Scheme. So that's something that is going to be looked at. Obviously, the continual improvement and advancement of crypto assets. So they invested significant monies on the crypto asset reporting framework, and that's going to be continual to be expanded. And what we're actually seeing in practice is a lot more HMRC investigatory letters. I think, since COVID, a lot of investigations were put on hold, and we did see in practice, a lot less HMRC letters to come through. Since Labour have come in, we're seeing a lot more letters from HMRC, a lot more one-to-many letters in certain industries. And I believe now, after the budget and the monies that are going to be going into HMRC, we're going to be seeing even more investigations to clients into their matters. So I guess the point of this is that, and I'm sure you are all complying correctly, but it's fundamentally very important to comply and be reporting accordingly. Obviously, we've got Making Tax Digital coming in over the next year for small businesses, sole traders, and landlords that have £50,000. So that will be coming in. It was announced in the budget that there are, for the first year, there's not going to be any penalties for late filing. So they've eased off for everyone on that year and some other exemptions, but we'll be doing another webinar for all our clients ahead of that deadline. So I think the overall impact was of the budget was, I guess, for a lot of my clients were concerned around the wealth tax, and I guess this idea of the mansion tax wasn't as bad as what it would say it was. An exit tax, which hasn't come in, certain restrictions to business asset disposal relief, which still remains at the £1 million level, and other bits and pieces. But equally, landlords continue to get hit very hard. We have the opportunity for inheritance tax, and what I see in practice is a lot of businesses looking to leave the UK, and I was hoping that there'd be more incentives for businesses and families to prosper and remain in the UK, and I think that trend is possibly going to continue to look at other locations. In terms of tax planning, these are some things that you should consider. Firstly, the sheltering of the business property relief and agricultural property relief, I've already mentioned. You can look at that 100% relief on inheritance tax, gifting of shares within this tax year. So we have 3 months to do this, to look at the planning, to implement, to decide whether that's the right thing or not. There is anti-avoidance. Anti-avoidance meaning that if you die within the 7 years since gifting, then essentially after April, then the old rules will apply. But essentially, if you survive 7 years from today, then those gifts will qualify accordingly for the business property relief. Use of trust. The rules have not changed within the budget. It's the only way within the UK you can protect your bloodline, you can protect your assets. So consider that. Business asset disposal relief. So that's the capital gains tax relief available when you sell your shares or business assets. So that is, you get £1 million subject to capital gains tax, the first million at 14%. From April 2026, that first million is going up to 18%. So if you are looking at selling some of your shares or going through a share sale, you may want to look at concluding that, if you can, by the new year. Corporate groups, no rule change on that. You still want to consider your corporate structures in the UK. The most efficient thing to do from a tax perspective is still sheltering your income through the corporate entities, and as corporation tax is lower than income tax, obviously. Family investment companies still remain an excellent strategy for tax planning and inheritance tax planning, and that ties into everything of what I've said. One thing, sorry, I said I was going to mention, which I haven't mentioned till now, is around property investors. So obviously we've spoken a lot about if you own property in your own name or joint names or individual names, then you need to be looking at structuring. What does structuring mean? It means, can you move your personal assets into a new structure, trust or limited company or partnership? A lot of people are looking at moving their properties to a limited company. Okay, that movement, that gift between your personal assets into a company will result in capital gains tax and stamp duty. Okay. Now, if you have a large portfolio, if your properties are owned in your individual names and that is your main source of income, your main business, you can potentially consider claiming incorporation relief, which is a capital gains tax relief. When you incorporate your whole business, it needs to be your whole business, all the debt, all the assets being incorporated, and then potentially there'd be no capital gains tax on that incorporation. Of course, over the last few years, we've had loads of people say they've got 2 properties, 3 properties, you know, can they claim incorporation relief? It's unlikely. It's unlikely. That'd be treated as investment. If you've got a main business, then you could look at incorporation relief. In the budget, there is a rule change on incorporation relief, whereby the relief, you used to be able to claim the relief automatically. So if you qualified, or if the accountant or tax advisor believed you would qualify, then essentially it would be an automatically claimed relief. Now, it's not going to be an automatically claimed relief, meaning that you have to put through the necessary returns and documents for that to obviously be claimed. So it's very important that if you do own the properties personally, then you seek good, strong advice on whether you'll be able to incorporate or not. So essentially what I do and why people come to me and why I'm a bit unique and my company's a bit unique is that, you know, we essentially start by having a strategy session with our clients, because there's no single one solution. We agree on a number of outcomes so we can illustrate the short, medium, long-term tax impact on a number of different outcomes. So the client can see the benefits of doing these different options, short, medium, and long term. And of course, tax isn't always the main driver. There could be personal reasons. Then collectively, we meet up, see what you like, what you don't like, until we get to a very refined, actionable plan. And that is the intricacy of modeling of what clients need nowadays, because, you know, it is very tricky on trying to work out the best possible solution when you're incorporating inheritance tax, corporate tax, income tax, capital gains tax, SDLT, etc. So if you feel you'd like to, that would benefit you at this moment in time, the link is in the chat bar to book a consultation. Of course, if you want to email me anything, my email address is mitch@fcg.co.uk. So I've been speaking for around 45 minutes. Hopefully you have found that fascinating. I am just going to scroll down for some Q&As, and I'll see what they're saying. So if you do have any questions, pop them in the comment bar, and I will try and answer them. So thank you very much. Just give me a second, because I haven't been reading them as they've been through. So let's see what they're. So question here from Claire, thank you. Inheritance tax on pensions, does this have 1 million cap also? No, the pensions doesn't have a relief. That's just going to be pure subject as investment, if you like. On the inheritance tax calculation, that wouldn't qualify as a business asset. Question from Jake in Jersey. So nice. Do you see a rise in corporate structuring in respect of commercially owned real estate? Yeah, absolutely. As briefly just mentioned, you know, we a lot of clients that own properties in their own name are looking to look at potentially putting their real estate into a corporate, and certainly new assets being purchased within a limited company. We have had a lot more recently about, can they purchase their own residential property within a limited company? because of course, you know, some directors want to use the funds of their reserves to purchase their main home. We always try and advise against that for a couple of different reasons. Firstly, still the biggest tax relief in the UK is the ability around principal private residence relief, which means you have your main home. When you sell your main home, there's no capital gains tax to pay. So when you own that within a limited company, you'll lose that ability, so that if you were to sell that property and it made a profit, you'll be subject to corporation tax. The other thing to consider is that because you're an employee of the company, you're benefiting from the asset which is owned by the company, it will be subject to P11D, benefit in kind tax charges. And the third thing, just remind everyone that if you own a residential property which is owned by a limited company and valued above £500,000, and it's not commercially let to a third party, so i.e. you're living there or your family members are living there, there's a dry tax charge annually every year called the ATED, annual tax on envelope dwellings. So, you know, that will be circa sort of £4,000 on a £500,000 to £1 million property. So we've got a question: are the changes to the EOTs effectively immediately or after? So yeah, it's a good point. It's not affecting the existing employee ownership trust. This is for new transactions which are happening now, essentially. So if you'd already completed on an EOT, then that shouldn't apply to you. But yeah, thank you for your question. Let me see. I'll answer a few more. Is it pretty straightforward to move a buy-to-let from a personal name into an existing property investment company? So yeah, I mean, I guess when you mean straightforward, obviously you've got to treat it as a sell, I guess. So you'd have your conveyancer solicitor who would manage that. Remember that if you have made a gain on the property, so if essentially the tax calculation would be the market value price on the dates you move it into the company, less what you originally paid for it. If there's a gain, then you need to report the gain and pay tax on that accordingly within the 60-day period. So there's a bit of paperwork to be done. The other thing to bear in mind is that because you wouldn't legally own the property as an individual, it would be the company, then any debt would need to be looked at. And of course, you'd need to consider any potential exit charges on that transaction as well. Let me just quickly scroll down the chats as well. Yeah, sorry, so there's some other questions in the chat. So yeah, how's the surcharge going to be assessed? Is this a brand new valuation assessment? I think they were trying to avoid the bringing in a whole new valuation assessment. So but it's likely that the valuations will be updated every sort of 5 years based on their system. So that's how it's going to be assessed. Yeah, some comments about pensions. Very good. Okay, look, if you have more questions, then you can get in touch with us. You'll see there's also the lovely designed QR code as well. I'm going to write my email address so you can see that right now if you'd like to get in touch with me. And if you'd like to book in the consultation, that'd be absolutely fine. I do urge anyone that has a family and has business assets or farmland to expedite their plans prior to April. So please do get in touch if we can help. As part of Fusion, we host regular webinars, so please look out for our new webinars in the new year. we'll be focusing on making tax digital. We'll be focusing on year-end planning. So you're more than welcome to join in and enjoy that. If you are selling your business, our commercial team will be able to help with the legals and the due diligence. If you need to get that done by April, our team can help you with that. And yeah, we'll be delighted to hear from you. But I think I've spoken enough for Friday. So I thank you very much for joining me and your feedback. And I wish you all a pleasant weekend, and I wish you all well. Thank you very much.